All right. Today is Wednesday, the 31st of August, the last day of the month. So let's end it with a bang. And folks, I got a good one for you tonight. What happened today? We got the bounce that we talked about yesterday, tiny little bounce, and it did not last. The market went down, broke support, and closed at the lows of the day. In other words, the market could not find buyers, even though the algorithmic pump was there. The algo said, hey, I'll give you a little pump, dip buyers. And the dip buyers responded and said, no thanks. We're traumatized here. What does that mean? We need to go further down to find support and to find dip buyers. So we're going to talk about that in details in this program. I'm also going to talk about the macro news that we got today. And ladies, we have good news for you. I know I'm not just talking about Leo DiCaprio becoming single again. He's available. Yep, he dumped the lady friend of his because she's about to turn 25, and that's the expiration date that Leo has. So if you happen to be a young lady under the age of 25, you might want to apply to become Leo's next lady friend. But for those of us who are over the age of 25, well, we got to stick to macro here. Nobody likes us anymore. So what can we talk about? I've been thinking about the question that I've been receiving a lot, which is, hey Maverick, we see the Fed tightening the monetary policy. I hear all of these calls about an upcoming recession because the Fed is tightening. But at the same time, all I see is low unemployment. I keep seeing more and more jobs being created in the economy, and I keep seeing wages moving higher and higher. And at the same time, inflation is cooling down. Maverick, isn't this the soft landing happening right before our eyes? Or is it an indicator that the Fed is not doing enough in tightening the monetary policy? Or is there a lag in response when it comes to the jobs market? I'm going to answer this question using the data that we got today, and I think you're going to like it. So without further ado, here it is. In focus tonight. You're fired. Yep, you're going to hear that a lot if you happen to work in the airlines, travel, and leisure industries. And I say that despite the data that we got today. What am I talking about? I'm talking about the ADP employment report that we got in the morning today. Of course, they took a break for 2 months or so to fix their formula. We'll see if it's good or not. We have the confirmation from the kitchen of the BLS on Friday. But for now, private payrolls in the economy grew by 132,000 jobs in August. So the economy is still creating jobs. What's going on here, Maverick? Is the economy not believing the Fed? Or is the Fed not tightening enough? Or is there a lag? Or are we going to have a soft landing? Lots of confusion. So hear me out here. The devil is always in the details. When we look at small businesses, for example, the 1 to 20 employees, these are the grocery store, not grocery stores, but the convenience stores, bodegas, etc. Now, small businesses in this economy, the heart and the backbone of the economy, are actually suffering. And today we got more evidence to that fact. These small businesses lost 47,000 jobs in August, but small businesses with 20 to 50 employees gained 72,000 jobs. So they made up for the losses of really small businesses. Those kind of businesses created about 74,000 jobs in August. On the other hand, businesses with 250 employees to 500 employees lost 21,000 jobs. We'll look at large enterprises with 500 employees or more. They created about 54,000 jobs in August. More details. We'll look at the goods sector of the economy. Natural resources and mining created about 2,000 jobs. Construction, an impressive 21,000 jobs in August, while manufacturing was pretty much flat, nothing. Here's the alarming side. We will look at the services sector of the economy. Not a good look here. We're creating the shittiest jobs in the economy. For example, information lost about 1,000 jobs. Financial activities lost about 20,000 jobs. Professional and business services lost about 14,000 jobs. Education, health services lost 15,000 jobs, all in the month of August. On the other hand, other services, quote-unquote, created about 10,000 jobs. And then the Amazon, warehouse, trucking jobs created about 53,000 jobs. And then we have leisure and hospitality leading once again with about 96,000 jobs. So it is clear here. The economy is now becoming concentrated in Amazon jobs and the travel and leisure hospitality sectors of the economy. And these are the weakest jobs because they happen to be really cyclical depending on the economic cycle. And they also happen to be lagging indicators. Now hold your horses because we're going to revisit this in a minute. But before we do that, here it is. We'll look at age and gender. We're trying to spot wage inflation. Jerome Powell wants to crush wage inflation. It has to stop. He wants to take the excess out of the economy because with wage inflation comes, well, inflation. The majority of wage inflation is coming from the ages of 16 to 24. Yet another indicator that the economy is creating the shittiest jobs, the McDonald's, the waiters, bartenders, the travel and leisure kind of jobs. And these jobs are usually filled with younger employees with less experience. They don't require a lot. And you can see as people get older, we're not seeing wage inflation keeping up with the actual rate of inflation. So if you happen to be an older worker, you're losing to this inflation. Your wages are not keeping up with the rate of inflation. If you happen to be a younger worker, maybe in the travel and leisure sectors of the economy, maybe your wages are keeping up with the rate of inflation year over year, but the problem is, from a numerical standpoint, not really, because your wages are actually suppressed. And another finding is female workers are getting paid more than their male counterparts, so the wage gap is getting closed. And we're now actually seeing the opposite. Females are getting paid more than males. So there you go, ladies. You can see it here. There was a bigger gap in the heat of the pandemic because a lot of women were staying at home, taking care of the kids. But now that they're back at work, we're seeing the gap not only closing, but now we're seeing women getting paid more than men. And what could explain that, not just because women are getting paid more than men, it could be the fact that since women took time off from work and they are rejoining the workforce, they're getting higher salaries, inflated salaries. Because when we look at the gap between job stayers and job changers, it's a massive gap. Job stayers are actually losing to inflation. The change in their pay is below 8%, while job changers, their year-over-year median pay grew by about 19%. And perhaps this one is more important because when we look at the median year-over-year pay by age group, younger workers are enjoying higher wage inflation. But look at that. In recent months, that wage inflation has been trending down. And since we're seeing a response to monetary tightening, so for people who say, oh, we're not seeing any response of the change in the stance by the Fed, this is actually an early and leading indicator that we're seeing a response in the economy to the monetary tightening. And younger workers are enjoying higher wage inflation for two reasons. Reason number one, a lot of these workers during the pandemic moved with their parents. They cut down their spending entirely, and they're taking more time to join the workforce. So if you happen to be an employer looking for these kind of employees, you have to pay more to attract them to get out of the couch and work for you. Reason number two, these workers happen to work in the leisure, hospitality, restaurants, fast food kind of sectors of the economy, where the majority of wage inflation is coming from. And the reason is they're late to the game. They've been shut down for a long time. So now that they're coming back online, we're talking about airlines, hotels, cruises, etc. When they try to find employees, they have to pay more than companies that did not shut down. The tech, the health, information sectors of the economy. The more recent you are to the workforce, the higher your wage inflation is going to be. And therefore, it is not a surprise that the majority of wage inflation is actually coming from the leisure and hospitality sectors of the economy. These are the only workers in the economy who are beating the rate of inflation. Of course, if you believe the fake cooked inflation number from the Bureau of Kitchen Statistics. But the real inflation rate, we know that's above 20% easily. But sake of the argument, if we assume that the rate of inflation is indeed around 8.5%, the only workers in the economy beating the rate of inflation are the leisure, hospitality workers, along with the Amazon, trucking, and warehousing jobs. Besides that, everybody else is losing to this inflation. Now, to answer the question of why are we not seeing job losses in the leisure and hospitality sectors of the economy, because this is where the majority of job creation in the economy is. And it's not really job creation. You already know that. We're just recovering the jobs that we lost due to the thing. And it's not really due to the thing. It is due to our stupid leaders, politicians, and health officials. That's why. But regardless, why are we not seeing job losses right now? Why are we continuing to see wage inflation in this particular sector of the economy, leisure and hospitality? If Jerome Powell wants to be successful in taking down inflation, we have to see wages and the rate of job creation in leisure and hospitality slowing down, if not getting smashed. So again, the question is, why are we not seeing the impact of monetary tightening in the travel and leisure, hospitality sectors of the economy? Is it because the Fed needs to do more? Perhaps. Is it because the economy is not believing the Fed? Not really. The economy has no reason at all not to believe the Fed. The economy will follow whatever the Fed does. Or is it because we're about to have a soft landing where inflation goes down, but we continue to see wage inflation and job creation in the economy? This is a fantasy, a stupid one, of course. So what's going on here, Maverick? The answer is, it's coming. We're going to see a tsunami of job losses in airlines, hotels, casinos, cruises. The travel and leisure sector of the economy will get absolutely annihilated. Why are we not seeing this now? The answer is because it is a lagging indicator. It takes time until we see the impact. And I'm going to give you this example so you can understand. When we look at a company like United Airlines, for example, the revenue per employee in the second quarter of this year, 2022, was at around $132,807. In 2019, when travel was normal, quote unquote, before the thing, the revenue per employee was $120,528. So airliners are doing better than 2019, the normal period, quote unquote, when it comes to the revenue per employee. So you might say, hey, Maverick, there's no problem. Airlines are not facing a problem. They can keep these employees with the inflationary wages, no problems, right? The answer is wrong, because we're seeing the revenue per employee number inflated because of inflation, not because we're seeing more travelers, but because higher prices. They're charging more for the tickets, and therefore the revenues are inflated, and for now, this metric looks a lot better than 2019. But here's the problem. We will look at expenses per employee. In 2022 for United Airlines, that was $123,180. In 2019, it was $104,968. Now, the operational profit per employee, this year it stands at $9,627. In 2019, it was $15,560. So net, the company's not doing better than 2019, even though the revenue per employee moved higher along with expenses due to inflation. They're paying more in expenses because jet fuel, everything else is moving higher, their input cost. But they're also charging more for the tickets. They can, at least for now, so the revenue per employee can cover for that, but maybe not for too long. So as a CEO of this company, look at these numbers. How do you improve the operational profit per employee to match 2019? You can do that by jacking up the revenue by increasing airfare tickets prices even higher. But there's a problem with that. That could cause demand to go down. And net, you end up actually losing money. It backfires. So you're not going to do that. You're only going to do that during days and weekends when we know that we're going to have increase in demand. We're talking about Memorial Day, the 4th of July holiday, and the upcoming Labor Day holiday. What else? You can hope that your expenses will go down and somehow your revenue is going to stay the same. This is the fantasy/soft landing scenario. But the third option that you got to increase your operational profit per employee is to get rid of employees. But here's the problem. So long as there is high demand on traveling, with more holidays coming up, getting rid of employees right now might not be the right strategy, because what if demand stays high? And it's going to stay high in this upcoming Labor Day holiday, and perhaps all the way through the holiday season. You get rid of your employees, you're going to lose to the competition. The demand is still here. Why create a shortage of supply that could crush your margins? And this is the key answer to the question, why are we not seeing unemployment rising higher in the economy right now? The majority of jobs are created in the leisure and hospitality sector of the economy. This sector of the economy will not see job losses right now because it doesn't make sense at all. People are still traveling. So it doesn't matter how much the Fed tightens right now. You're not going to see the response by airlines, cruises, hotels, casinos. People are still traveling. The demand is still here. But here's the problem. As we start to see the demand in the economy weakening and the demand for travel weakening, and by the way, it's already happening. Forget about Labor Day. Of course, Labor Day, the demand is high. But besides that, listen to this. Overseas arrivals in August 2022, this month, these were down by 35% when we compare it to 2019, meaning airline travel is not really recovering 2019 levels. We're seeing demand right now, specifically in certain holidays, and the airlines have to respond by hiring more employees, but this demand is slowing down. The trajectory is down. Hotel demand was down 3% versus 2019. Even group bookings were down by 18% versus 2019. A matter of fact, we're not going to see a recovery in business travel spending all the way till 2026. So we know that the legitimate demand for travel is actually down, and it's not going to recover anytime soon. That doesn't justify airlines having a lot of employees right now. But the only thing that justifies having a lot of employees by airlines, and they continue to hire and pay extra wages, is inflation. They can charge more, but their ability to charge more will diminish. Why? Because the Fed is tightening the monetary policy. And today, Cleveland Fed President Mr. came out and said, we might actually go above 4% and do no cuts at all throughout 2023, meaning we're going to see the demand getting crushed even more, and airlines' ability to charge more for tickets will go down. And then, only then, airlines will start getting rid of employees. They're going to realize that they're paying these inflated salaries, the demand for travel went down, and they cannot charge higher prices for these tickets. Then they're going to start laying off employees like you haven't seen since 2020. So to wrap it up, the question is, Why are we not seeing a response in the travel and leisure sectors of the economy to monetary tightening? The answer is it doesn't make sense to lay off employees right now in the travel and leisure sectors of the economy. But as the economy starts to feel the impact of monetary tightening and we see employees out of the leisure and hospitality sectors of the economy getting laid off, we're already seeing that. Did you look at the ADP report? A lot of other sectors are losing jobs. And as we continue to see that, the demand for travel will move down. And these companies will not be able to charge more for tickets anymore. They have to reduce prices because the demand all of a sudden is getting weaker. It's already getting weaker. So it is just a matter of time before we start to see layoffs hitting the travel and leisure sector of the economy. It's coming. It just happened to be a lagging indicator. So next time somebody says, hey, there is no recession coming because the unemployment rate remains low, the economy continues to create jobs, how could you say that we're going to have a recession coming? You can respond to them by saying, do you know where the majority of jobs are being created in this economy? Do you know where the majority of wage inflation is happening in this economy? The answer is travel and leisure. Travel and leisure is not going to lay off employees until we see weakening of demand around the travel and leisure sector of the economy. I hope this is clear. And if it's not, I think it's your problem. Anyhow, we're going to move on here. Let's try to get you off here a little earlier. Let's keep it short and sweet. And by short and sweet, I mean, 40 to 50 minutes? Anyways, let's move on to see how the indices closed today and cover the stock market information for you. And here we go. The Dow Industrial Average down by 280.44 points, or a decline of 0.88%. The Nasdaq down by 66.93 points, or a decline of 0.56%. The S&P 500 down by 31.16%, or a decline of 0.78%. The sector's performances pathetic across the board, nothing closing in the green, so shame on all of them. And the wall of shame is led by materials, energy, and financials. What about the advance to decline ratios? The NYSE 27% advancing versus 71% declining. The Nasdaq 41% advancing versus 54% declining. Not a good breadth for the NYSE, but look at the Nasdaq. It's as close as you can get to 50-50 because of Meta. We'll talk about that in a second, but if it is commodities, we continue to see weakness in energy commodities. Both the WTI and Brent were down. WTI by about 3%, Brent down big, almost 4.5%. Likewise, the crash in gasoline RBOB continues to go on, down about 4.5% today alone. Heating oil down about 4%, but the party boy, natural gas, closing in the green by about 1%. Now, let's answer this question by the viewer. It's a good question, actually. He says, why long Coterra when energy and gas should do poorly in a recession, shouldn't it? The answer is yes. Recession is not good for energy and gas, and you're already seeing the impact of monetary tightening on crude oil, for example. But when we talk about the headwinds versus the tailwinds, they're different for oil and gas. For natural gas, for example, where Coterra is, what are the headwinds? The headwinds are monetary tightening. The Fed is tightening, crushing demand in the economy. What are the tailwinds, though? The tailwinds are we might see a massive supply shock that could undo the monetary tightening. And then the Fed and central banks have to be even more aggressive in crushing demand because they have no power at all in increasing the supply. What are we talking about here? The most important tailwind for natural gas is what's going on in Europe. The sanctions. They thought that what they can do is delay the sanctions on Russia when it comes to oil and gas. And they can use that time between now and then to accumulate as much natural gas in their storage as possible. The problem is the Russians caught up to that, and they're cutting the supply right now. So we're seeing natural gas, the prices that is, exploding higher across the board. Be it American or European, it doesn't matter. So we might be in a phenomenon when it comes to the energy market of stagflation, where inflation in these commodities remains high while we see the demand getting crushed due to monetary tightening and the natural evolution of the cycle of inflation. And this is why I'm betting on natural gas to stay high for a long time. Now, when it comes to oil, the answer is yes. Oil suffers in a recession. But once again, we have this unique factor, the sanctions against Russia, the boycotts, and that is a massive tailwind that could keep crude oil prices higher for longer and make the Fed's job even more difficult because commodities and inflation will respond to monetary tightening, no doubt about it. The problem is when you're being countered, as the Fed, you're being countered by supply shocks due to the war in Ukraine and the boycotts and the sanctions. You got to do more. You got to keep doing more and more and more. And at some point, you have to come to the realization that if you keep crushing the demand too much, you're going to create a severe and a deep recession. And this is exactly what we're going to see in Europe. Because the ECB is going to tighten more. We're expecting 75 basis points after the readings that we got today regarding inflation. Yet they will continue to suffer from higher prices of natural gas and oil. It is the nightmare scenario. it's the worst outcome at all. Now, when it comes to the tailwinds for oil and why we could see a surprise comeback of oil, despite all of the talk of peak inflation and oil prices going down, they could actually pop higher again. And once again, it's due to what's going on in Europe and Russia. And I'll let this guy explain it to you. He's a former VP in Aramco, so he knows a thing or two. Take a look.
I think what we're seeing is the impact of the last few months of OPEC increasing production, the release of SPR supplies, and in general, the ability of Russia to get around some of the sanctions. But going forward, these are going to get a lot tighter, the sanctions. There's also a limit on shipping because the Russians will not be able to use any of their vessels. And, you know, it's a two-part problem. One part is oil, and the other part is gas. Now, gas has gotten so expensive, 4 or 5 times its normal price in Europe, that the Europeans are resorting to using oil instead. So that's adding another dimension to the demand. And frankly, there are no more supplies. As we go towards the year end, the IEA forecasts an increase in demand to over 100 million barrels a day. So when you put it all together, it's going to be a tight market.
Although, you know, Sadat, coming into this summer, there were expectations things would continue to be fairly tight. And yet it's been disproved to a certain extent. Are you surprised by the move down over the last few months?
No, there was a window of 6 months which the Europeans gave the off-takers to try to accommodate their requirements. So they kept buying and getting access to oil. Also, like I said, OPEC has added about 1.5 million barrels during this time frame, and the SPR added 1 million barrels. So that overcame the drop of about 2.8 or so million barrels of Russian oil up to that point in time. But going forward, there's going to be another 1.8 million barrels of Russian products and oil that will not be in the market. And as I said before, you've got that 12, 14 billion cubic feet of gas that goes from Russia to Europe, and that is likely not to continue for very long. Already Nord Stream 1 is down. Nord Stream 2 was never operated. Blue Stream is going to be shutting down. So the problem will compound itself. The summer was not an illustration, I think, of what's going to happen during the balance of the year.
Now, on top of all of that, one of the sources of optimism that pushed oil prices down is the fact that we might be close to an Iran deal, a nuclear deal. The problem is the deal is not going to happen without approval from Israel. And today we got the news that the Biden administration assured Israel they're not going to do anything without their approval when it comes to the Iran deal. But here's the problem. If these tailwinds play out that the VP from Aramco talked about, and we see oil prices moving higher, at some point the Biden administration will realize that they cannot just continue to appease Israel because there's a backlash domestically with high oil prices. So they're going to have to make a deal with Israel. What would Israel's response be? Are they going to launch a war or bomb Iran facilities? That could push oil prices even higher. So there are tailwinds here. There are a lot of scenarios where we could see a revival in the rally in oil, but specifically natural gas. I could be wrong, but so long as these tailwinds are still intact, I continue to hold on some exposure to the oil and gas industry. Back to the futures. What about softs? We have a mini rebound in lumber, about 2% or so, and then OJ rebounding big. The rebound continues in OJ. You see all of these commodities being picked up again. OJ up about 5.5% today, and cotton stabilizing and gaining about 1% today. On the other hand, we have losses for sugar of about 1%, while cocoa and coffee pretty much in the flat line. The problem is when it comes to metals commodities, the recession indicators, they keep getting crushed. Gold down, silver down, platinum down, most importantly copper down. Even palladium was down, be it on the flat line. When it comes to meats, even the new big tech is down about 2% today, along with live cattle futures. On the other hand, feeder cattle futures on the flat line. Grains, a rebound, modest one for wheat of about 1.5%. Likewise, soybean oil gaining about 2% or so. And then we have modest gains for rough rice, but everything else, soybeans, soybean meals, corn, oats, canola, all down. Now, I said yesterday that I'm still bearish on soybeans, but that might change because prices go down and then aggregate demand kicks in, and that keeps inflation high. What are we seeing right now? We're seeing the Chinese buying the dip in soybeans, buying more soybeans from the US and Brazil, taking advantage of these lower prices, so they might not stay low for too long. And this is the problem that the Fed has to deal with. There is an aggregate demand problem along with all of the tailwinds that we talked about. Moving on to the big casino, the options market, what's going on here? The volume is down again, and we're seeing more buying of puts. Not a good sign. Not a good sign at all. Apple came at number 1 at around 1 million contracts. By about 52% of those are calls. Tesla, number 2 at around 950,000 contracts. But look at this, about 56% of those were actually puts. Amazon, about 700,000 contracts traded today. About 55.5% of those were puts, not calls. This is yet another sign that the market is not finding support. The market is not finding buyers. It needs to go down further until we get to an attractive price from which we can find buyers. The buyers might see an opportunity in dip buying. The problem is, with the recent trauma that we got, everybody thought that the summer rally is it. The bottom is here, higher we go, and they stampeded. And they got a massive pie in the face. Now that creates trauma. What does that mean? It means we need a catalyst. We need some reading of some sort that could give the dip buyers the courage and the reason to buy the dip. Could it happen from Friday's jobs report? It could, but not likely. And I don't see a lot of data or a lot of events in the near horizon that could be a reason for the bulls and the dip buyers to have the courage to step in and buy the market. This is a major problem for the bulls. But perhaps we have a seasonal factor coming in, and that is Labor Day weekend. It's going to be a shortened trading week next week, so we might see yet another attempt of a bounce and dip buying, maybe tomorrow or even on Friday. We're going to talk about that in details when we talk about the charts, but for now, let's move on to cover the unusual activities that took place in the options market today. We start with the ticker TLT. This is for the long-term bonds. Somebody sees a bounce coming, a big one. They bought the 120 calls for the expiration date, September 30th, with expectations that the name could move higher and gain more than 7% by then. They paid about 45 cents apiece to enter this trade. All in all, spending around $800,000. And then what about the ticker IWM for the Russell 2000? I'm short. Somebody's doubling down here. They bought the 162 puts for the expiration date, September 30, with expectations that the name could move down and lose more than 12% of its value by then. And they paid around $1 apiece to enter this trade, all in all spending around $750,000. And then what about the ticker XRT, the retail ETF? Somebody's bidding for more pain to come. They bought the 55 puts for the expiration date, October 21st, with expectations that the XRT could move down or lose more than 13% by then. 13. 1-3, and they paid around $1.75 apiece to enter this trade, all in all spending around $1 million. And then what about the ticker R for Ryder Trucking? Somebody's buying calls. They see upside in this name. They bought the $90 calls for the expiration date, November 18th, with expectations that the name could move higher and gain more than 18% by then. They paid around $1 apiece to enter this trade, all in all spending around $500,000. And then we're going to skip the XLB because the spread is too wide. I will go with the ticker GOOG, Google, the big Goog. Somebody sees more downside. They bought the 95 puts for the expiration date, November 18th, with expectations that the name could move down and lose more than 13% of its value by then. They paid around $2.60 apiece to enter this trade, all in all spending around $1.3 million. Moving on to the heat map analysis, what's going on here? Down across the board, in the beginning, everything was pretty much higher, and that's how we know it's an algorithmic bump that's not going to last. Although some of the gains stuck. These gains in the Chinese names, Alibaba, JD, Pinduoduo, but also in Meta. We saw Snapchat bouncing higher with the news that they're getting rid of employees, and the market's thinking is perhaps Meta will do the same, reduce their expenses and improve their margins. And therefore Meta was higher. But besides that, everything else is weak and down. So let's talk about corporate news because we have another factor that added to the pain after hours, and that is Nvidia. So my belief is we should have seen a bounce today. Maybe it's not going to last, but we should see a follow-up tomorrow on the attempt to bounce and perhaps on Friday. But now we have a factor that could delay that altogether. And that factor is Nvidia. Nvidia came out after hours and said that they're going to downgrade once again the revenue forecast because the United States imposed new requirements to sell their products in China. Now, if you looked at Nvidia's earnings, the last report, it is abysmal. Besides data centers, gaming is down, crypto mining down, the business is slowing down dramatically. And now you have another shoe that dropped. Not good news for Nvidia. We're going to see chips down big tomorrow. We're going to see big tech down big tomorrow because I have a conspiracy theory here. So do me a favor and grab your tinfoil hats. Yesterday, we talked about Apple diversifying and moving away from China to manufacture phones in India. Today, we're hearing about new license requirements by the United States government to do business in China. Today, we heard Warren Buffett, Berkshire Hathaway dumping BYD, at least a slice of that holding. What's going on here? I'm smelling something here, folks. Something about let's get out of China because they might punish our companies in the future as retaliation or whatever. We're trying to get ahead of that. Or are we about to see the invasion of Taiwan? Just something to think about. Next, we have Bed Bath & Beyond. What a disaster that is. Bloodbath & Beyond, I should say. The meme stock chasers chased that to oblivion. They lost all of their gains. To the moon, bro. Ended up being to the dumpster, bro. And today we got the plans from Bed Bath & Beyond, the restructuring plan. They're going to close hundreds of stores. They're going to get rid of 20% of their employees, and they got a loan of about $500 million. Not going to be enough. It's just a matter of time here before this company declares bankruptcy. I mean, look at this. Same-store sales for Bed Bath & Beyond this year were down 23%. And the trend is clear. It is absolutely collapsing. It's just a matter of time here, folks. And then we have MicroStrategy, the ticker MSTR, with drunk Michael Saylor. You know, he was a scam artist back then in the dot-com bubble. Of course, the newbies don't know that history, so they followed him in his preachings, and they lost big in Bitcoin. And today we heard from the AG of Washington, D.C., filing a lawsuit against Michael Saylor, saying that he failed to pay more than $25 million in income taxes, tax evasion, and the stock went down after hours. And then we have Tesla, the souffle. We talked about how stupid the culties are. The guy shits on their heads. They look up and say, "Thanks for the hat. Elon, we love you." Meanwhile, the souffle is treating customers like shit. The headline reads, "A Tesla driver reportedly discovered a dead mouse and rat poison in their frunk after service center visit," and it illustrates a growing issue with the car maker. And rumor has it the culty went on Twitter and thanked Elon for the free mouse. Anyways, we have Ford. Ford is now recalling more than 277,000 pickup trucks and cars in the United States because the rear view camera lens can get cloudy and reduce visibility for the driver. See, this is what happens when companies cut corners. Ford can afford to put HD cameras in the trunk, but they choose not to even though it costs a few cents per car, just so they can cut corners. Cut corners elsewhere, Ford. Maybe some of that EV stupidity, and give us an HD camera for the love of God. Next, what about the heat map for the ETFs? Not looking good either, although we have a bounce for China, Asia Pacific, the emerging markets and internationals, the double EM was higher. Some commodities were higher, natural gas, but that's pretty much it. Value down, growth down, materials down, energy down, technology down. But we have the XBI, the biotech ETF, scoring some modest gains today, a little under 1%. And we talked about the XBI having a bullish formation. The punishment that the XBI got may be too severe. We have a triple bottom. Can you lose a triple bottom? It could happen. Anything is possible, but the likelihood says if you have a triple bottom, chances are it is the bottom. And therefore, we're seeing some buying in the XBY because market participants believe that the bottom is in the XBY. We'll see if they're right or wrong. There's more monetary tightening coming. A lot of pain in the stock market coming. Can the XBY survive the pain? We'll see. But for now, let's move on to charts and see what's going on. We start with SPY, the S&P 500, 30 minutes chart. What's going on here? We got the bounce in the first half hour, the algorithmic bounce. But traders, market participants did not respond, did not buy the pump from the algos. What do you know? The chart flushed down. As you can see in the last two candles, this is a 30 minutes chart. The SPY tried really hard to climb 398, and it couldn't make it, and it closed at the lows of the day. This is a bearish closing, not a bullish one, indicating more pain to come. And if we do have more pain, we got the next support at around 393.16. If that doesn't hold, we have to zoom out. This is an hourly chart this time around. We have the gap below at around 391, and that should be good support. I say should. No guarantee it's going to hold or not. But my thinking right now is we have Labor Day weekend coming, and we have a shortened trading week next week. What does that mean? The volume will go down next week? That's number one. Number two, we're going to see a lot of shorts closing positions booking gains before the long holiday. So if we go down, let's say it's a severe drop due to NVIDIA, and we go down all the way to 391, I'm going to watch the behavior of the chart. Is 391 holding? Are we seeing some dip buying? And by the way, it's not going to be dip buying. It's going to be short covering before the long holiday. If I see more of that, I'll be taking profits from my short-term put options. And for the long-term put options, what I'll do is the following. I'm going to sell. I'm going to open a spread. I'm going to sell some put options with next week's expiration. It's going to be a shortened trading week. The likelihood is if I sell out of the money puts to raise some cash from the contracts that I still have for October, for example, next week, we're not going to see that flush down in the indices where these puts are going to be in the money. This is what the risk versus reward says. But even if we go down there, I'm covered by the spread. So this is my strategy right now. What about the daily chart for the continuous contract for the SPY? The problem here is the chart lost 3,960 as support. Next stop is 3,855. And that, losing 3,960 is pretty bad because the chart will make a lower low. And if that happens, if we see a closing tomorrow below 3,960, and better yet, below 3,855, we're going to talk about visiting the June bottom. The momentum indicators say that we have room for that scenario to happen. The volume says we have room for that to happen, but the seasonality says maybe not too fast. Maybe it's going to happen eventually, but not right away because we have Labor Day weekend. We could see some short covering and lower volume next week. So keep that in mind. What about the Qs? 30 minutes chart. What's going on here? We got the pump in the morning, but no buyers followed up. So the algorithmic pump went to waste and the chart went down. It went back and forth, battling my number, 372. You could say 300, doesn't matter to me. It's a zone, not a specific number. And by the end of the day, the chart failed to climb the very important number and closed at the lows of the day. This is bearish, indicating more losses to come. And if the chart goes down, how far can it go? We have to zoom out to an hourly chart, and we have closing the gap at around 294.33. The bulls better hope that this is going to hold. We should see a rebound from this point on, because otherwise, it's going to get really ugly. Instead of short covering before the long holiday, we could see panic selling and de-risking instead. So keep that in mind. 294.33. The bulls must bounce and hold. And here's the daily chart for the continuous contract for the NASDAQ. The problem is they lost 12,207 as support. The likelihood is they're going down to 11,689. And if that happens, not only the trend line is broken, but the chart also formed a lower low, indicating the June bottom will be retested once again. The momentum indicators remain negative, both the RSI and the MACD. The volume still above average on down days. Not a good look for NASDAQ here. What about the IWM 30 minutes chart for the Russell 2000? It went down to a soft support at around 183.25. The likelihood is, after NVIDIA, this is going to break. It is contagious, and the IWM will go down too. If it does, we have to zoom out to an hourly chart and see where we can find support. Besides 183.25, we have another soft support from a previous gap at around 182.81, but these are really close, so I'm not going to look at it. I have 178.60, another soft support, but folks, the real support is all the way down at 174.22. What we're waiting for right now is we know we have a shortened trading week next week. We know we have Labor Day weekend coming. The question is, where will the de-risking be? How will the de-risking take place? Is it going to be a gap down tomorrow and the shorts respond by buying the dip to cover their positions and take profits ahead of the long holiday? Or are we going to see more selling by the holders as they panic before the long holiday? In my assessment, if certain key support lines are broken, we're going to see the latter. Dixie, the dollar index, what's going on here? This is an important chart, bullish consolidation. It appears the Dixie wants to give it another shot to crack above the resistance once and for all. And if it does, it's going to be an explosive move higher. So we're waiting for that. If that happens, gold will go down, and the gold bugs better hope that gold will not violate the support of 1,685. Otherwise, it's going to get really ugly. If we see that support being violated, I'm going to have to cover the chart again and zoom out with a weekly chart to see the next support. What about Brent oil? This is a 4 hours chart, and it is battling the most important support at 94.47. The oil bugs lost an important support in 99. That shouldn't have happened, but it did. And now they have the last support at around 94.47. If they lose that, they have soft support at around 92. But folks, if they lose 94.47, the likelihood is we're going to see a flush down. We might see Brent oil under 90. So before the end of the week, oil bulls must step in and buy the dip here. For one thing, we have the seasonality of hurricane season. That could push oil prices higher. We also have the upcoming tailwind of the shutdown of Russian oil. You take a few million barrels out of the market, oil should move higher. What about the 10-year yield? Steady Eddie, moving higher, no problems here. It's going to get overbought at some point, perhaps at the next resistance at around 3.28, but it could go higher. It could go all the way to 3.5. The hour side, the MACD indicators all say that there is more room to the upside for the 10-year yield. If that is the case, there is more room to the downside in the TLT. This is a weekly chart, still above the trend line, but we're getting close here. Now remember, there was a mystifying event of the options trader who bought some contracts in the TLT, call contracts. Are they just gambling, or do they know something we don't? Let me know in the comments. The VIX 4 hours chart, what's going on here? We talked about a failure of the ABC pattern, the subsequent one. But now we have another pattern, which is a bull flag formation. Yes, the MACD indicator is showing negative momentum, but that can reverse easily. And we could see another leg higher in the VIX. But the risk versus reward says now that the MACD is extended higher, and this move higher in the VIX from 20 to all the way to 28, 29 is impulsive in a short amount of time. We should get a break in the VIX. Could that happen hand in hand with the seasonality of Labor Day weekend and the short trading week next week? And if that is the case, that the VIX is going to go down, we will see a rebound in the SPY. The question is, from where? We have to see what happens tomorrow. The assumption is we get a gap down in the morning. If the dip buyers tip in right away, then you got your answer. The shorts are covering, things are improving. We should see a relief all the way through Labor Day weekend and perhaps next week. Otherwise, if the dip buyers don't show up tomorrow, the sellers will show up again. We will see a flush down as they de-risk before the long holiday, and the VIX pops higher big time. Apple, the daily chart, what's going on here? It lost the trend line of support, but it is now holding at an important support of 157. Why do we say an important support? Because the bulls are hoping, if you look at the weekly chart, and we talked about it in maybe 2 videos ago, the reverse head and shoulder formation. That's not going to happen if Apple loses 157 and the last one 150. So for now, if Apple loses 157, not a big deal. The reverse head and shoulder is still on the table. But if Apple loses 150, that will be a major problem. Now I have the 160 puts for October. My strategy is, now that we have a shortened trading week next week, and the assumption is we might see a bounce coming, or at least a stop of the bleeding. If I sell the 150 or the 145 for the expiration date of next week, I see that as an opportunity to raise some cash from my contracts. The trick here, folks, is if you have longer contracts, longer expiration contracts, make them work for you by producing more cash, by opening spreads with shorter expiration dates. Tesla, an hourly chart, what's going on here? The name moved higher, could not make it above 280. We got a rejection right away. And now it's forming a bear flag pattern, indicating that Tesla should move down. If it does, we have 258.79 as support, which happens to be another gap from late July. And again, is it going to hold? Are we going to see dip buyers? If that is the case, the next week should be steady Eddie for Tesla, and it could keep 258.79 for a little while. But if that support is broken, we have 248.71. We'll take it one step at a time. And lastly, Bitcoin, tulips, what's going on here? The double bottom is still here. The chart is still holding. This is a 4 hours chart, by the way. It is still holding at the important support of 20,000, so we could see a pump here. It all depends on the sentiment. Where will the de-risking happen? Is it from the shorts who are going to buy and produce a pump, or is it going to be from the holders who are not selling yet, and they're going to capitulate and sell before the long holiday? If the latter happens, Bitcoin goes down. And lastly, moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have initial jobless claims. We also have the most important, manufacturing PMI. This is the final reading. We also have construction spending. But we have another zombie from the Fed, Raphael Boystick from Atlanta speaking. Who cares? For now, folks, this is all I got for you. Thank you for listening. Thank you for watching. I will talk to you again tomorrow. Take care.